Hey, welcome back. Getting back with another Chinese company, Baidu. They provide a search engine where they have over half of the Chinese market share. That's the core of the business. Plus, they have their own Netflix or YouTube, autonomous driving, AI, cloud, devices, fintech and more. They are very similar to Alphabet, which by the way isn't allowed in China, so they are basically China's version of Google. The overall business is relatively flat, but the smaller, high growth parts of the company are developing okay. They talk about the currently unfavorable market conditions and the company's focus on controlling the costs. At the same time, the company's margins are improving, getting to some decent mid-teens to even 20s. And also important, we can see that pretty much everything is above the company's average. We see a huge amount of investing last year and the company has always kind of done what America's big tech does. They invested in autonomous ride-hailing, a lot of AI, even some AI-powered biotech, so a lot of things that can grow very well. As you are about to see, they make and have a ton of money from the classic search engine side of the business that they use to develop the growth. In this aspect, it's very similar to Alphabet. They can make around 3-4 billion now and we can see some nice growth in the operating cash flow. 3-4 billion on a 20-something billion market cap is definitely good and it's among the lowest in the Chinese big tech. Even for them historically, it's very low. But we can see that there isn't really that much growth in the overall business. Sure, their older investments are becoming more profitable and the margins are maturing, but they haven't really been adding that much. The lack of growth might have to do with the pandemic and China's crackdown, but still, that may be about to change. Financially, we see a very good position with the current assets covering all the liabilities and barely any debt, which they've been repaying since around 2021. What's impressive is that they have around 38.5 billion in equity on a roughly 30 billion market cap. For a tech company, that's very cheap, but that's not all. We see 4 billion in cash, 14.8 billion in short-term investments and another 12.6 billion in long-term deposits. So basically more than the market cap is in cash or interest-bearing deposits. This sounds amazing, but my personal problem with this is that this has been the case since like forever. Sure, they make like $1 billion through interest, but that's really not good for that much money. It's significantly worse than US treasuries, so why aren't they investing it? Are you telling me that this company full of disruption tech and stuff like that doesn't have anything better to do than a 3-4% deposit or whatever? And I get holding like a 3-4-5 billion, sure, but 30? That's literally the whole company's value today. But rate cuts should eventually push them into finding better investments. Now think about this from the perspective of a buyer. You pay, let's say, 40 billion to buy them, so a premium on the current price, you get 30 billion in cash minus 20 billion in liabilities. So 10 billion in cash net of debt plus another like 30 billion worth of assets on the balance sheet. Sure, a bit of goodwill, but think about everything that you can't put on the balance sheet. How do you value the search engine, for example? Plus so many other investments with huge potential, similar to Google. At 40 billion, this would basically come for free. You buy a digital company that makes a ton of money for the value of the physical assets alone. But again, this has been the case for quite a bit, so keep that in mind. So they've been investing a bit, but mainly focusing on maintaining a solid cash position and repaying the debt. But I don't see that going on forever, and now with the shift in China's policy, it could be about to change. I mentioned it in the other videos about Chinese stocks that we've looked into recently, but simply put, it's a bunch of measures meant to stimulate the economy. Rate cuts, wage increases, support for the markets, and many others with a clear effect. It's also meant to combat the tariffs, and if they are reversed on top of this, that can be very beneficial for Chinese companies. Now, for Baidu in particular, the tariffs aren't really that big of an issue, but they can affect the country and especially the market's opinion on China. And that's the main thing behind this investment. If the market's confidence improves and they are back to 15-20x the cash flow, which is okay for this kind of tech in foreign markets, that's like a 2-3x by default plus the company's potential to grow. And keep in mind that rate cuts in the US and EU will push money into higher risk, chasing a better yield. Not tomorrow, but it's something we can see throughout the economic cycle. Even now you can get a 4-5% from the theoretically risk-free US treasuries, which back in 2018-19 would have been an amazing yield. But nothing is guaranteed and China is far from being risk-free, and the system is completely different. They also announced some 5 billion buyback program back in 2023, of which they completed around 1.4 billion. So 3.6 billion left, meaning more than a 10% yield in total, which is not terrible. They don't pay a dividend, but they can definitely afford a pretty good one. Now let's see a valuation. In a bad scenario, interest dropping in half, that's $500 million gone, plus some internal issues, let's say they get to 2.5 billion per year. Traded at a ratio of 8, and that's a 20 billion market cap, meaning a price of 56.95, so a loss of around 30%. But at the same time, can they fall to that much? Yes, but the balance sheet should offer kind of a safety net, because it gets to a point where the cash alone covers the investment and it's basically free money for a potential buyer. And even without a buyer, because let's say China wouldn't allow it, they can do massive buybacks, and we know that the market reacted very well the last time they did it. Say you plan some 10 billion buyback program and that's half of the market cap, no way the market doesn't react. Now in a second scenario, let's say the lower interest rates force them into some investments and they stabilize at around 3.5 billion in the medium term. For a ratio of 10, that's a market cap of 35 billion, meaning a price of 99.66 for a 25% profit. They were close to that even in December, so I don't think it's that impossible. In a good scenario, let's say the investments and China's policy shift pay off and they get to 4.5 billion per year. Add some market confidence and trade them at a ratio of 15, which is still pretty low, and that's a market cap of 67.5 billion. That's a price of 192.2 for a profit of around 140%. It can be much better, but even this in say a few years would potentially be huge. Obviously things can get better or much worse because it's China after all, but the risk and reward seem pretty good in my opinion, and I already bought a bit even recently. I get them not doing something better because of the environment for a few years, but now with the shift in policy and so much cash, it would be quite an achievement not to do better than a 3% return on investment. Overall it's definitely interesting and I own some of these. I really like the current price now that it fell, and I think it has potential to do very well. Again, very healthy, makes a lot of money and has a ton of money on the balance sheet. With rate cuts kind of forcing them to look into alternatives, we can probably see them develop pretty well. You know, they don't have to stay in the same industry and focus only on that. Any big tech you look at in China, including them, is developing both horizontally and vertically. They can continue copying Google, Apple, Amazon or whatever and go into things that would attract the market. They already have some joint venture into EVs, autonomous ride-hailing, smart devices and so on. 30 billion in cash can buy their way into pretty much anything they want in any country, it doesn't have to be China. But again, China is China, so there is political risk and a very different system than what we normally see in the market. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.